Welcome to Satya Skills. In this video, let us learn about bank rate. It is a powerful weapon in the hands of RBI as a credit controller. Bank rate is the official minimum rate at which a central bank lends to domestic banks and also rediscount bills. In USA under Federal Reserve System, bank rate is also popular as discount rate. By managing the bank rate, central banks regulate the economic activities. All the central banks charge the bank rate against loans sanctioned to other banks, especially commercial banks. In the context of Indian banking, bank rate is the rate at which the Reserve Bank of India provides loans and advances and also discounts bills of banks and other financial institutions. Section 49 of the Reserve Bank of India Act 1934 defines bank rate as the standard rate at which the bank is prepared to buy or discount bills of exchange or other commercial paper eligible for purchase under the Act. Thus, bank rate is the cost of obtaining finance facility from the RBI. RBI used bank rate to raise or reduce the cost of finance and quantity of its availability to the banks, especially to the commercial banks. When the inflationary trends prevail, the bank raises the bank rate. This act of RBI leads to an increase in the cost of refinance from the RBI. If RBI senses shortage of funds, it reduces the bank rate, thus it reduces the cost of finance. Variation in bank rate directly influence the other rates in the money market. Thus, the borrowings from the commercial banks also become expensive. According to requirements, the RBI charges bank rate. For a long time, RBI never used bank rate to control credit because the influence of RBI's bank rate was not intense on Indian money market because Indian money market was not a developed market. For the first time, bank raised bank rate from 3% to 3.5% in 1951 to check the expansion of bank credit. In 1957, it was increased to 4%. During 60s, bank rate was found ineffective to check inflation. Therefore, bank introduced a new system, quota cum slab rate system, where interest was charged differently on different slabs. In 1964, bank rate was raised to 5%, in 68 to 6%, later there was gradual increase and by 1991 it was raised to 11%. In 1997, for the first time, bank rate was reduced from 12% to 9%, the maximum reduction in the history of bank rate. Remember, it is in the context of banking sector reforms and liberalization during that time. Now, the bank rate is at 4.25%. Now, bank rate versus repo. Do not get confused between bank rate and repo. Repo is the rate at which RBI lends to other banks against the security of government securities, whereas bank rate is the rate at which it is charged for loans to banks without any security. So, repo secured loan, bank rate unsecured loan. Both are for short term loans only. That is all in this video. Thank you for watching. God bless you.